What is the state of the South African consumer? It's something that we talk about almost every day on Power Lunch, and latest data coming out this morning shows that it's not as healthy as it was this time last year, because the TransUnion SA Consumer Credit Index, the CCI, has decreased to 44.4, it says here, in the first quarter of 2013 from a revised 49.4 in the fourth quarter of 2012. In the Power Lunch Johannesburg studios, George Glinos, the MD of Econometrics Treasury Management, ETM. George, thanks very much for joining us. This is quite a sharp fall. 50, let me explain, is the cutoff, isn't it? It's like a sort of a PMI style index. Above 50, healthy. Below 50, not so good. So 44.8, not very good at all.
No, not a great reading. As you quite rightly pointed out, it works in a sense like a diffusion index. So anything below 50 reflects deterioration. Anything above 50, improvement, and to the extent that it deviates away from that 50, gives us a sense of just how significant that deterioration is. In other words, something just below 50, the deterioration is minor, but as we progress away from that 50 barrier, so the deterioration in this case is a lot more significant.
Yeah, and also significant is this second paragraph of your press release, which you kindly sent us earlier on. It says the decline in the index reflects not just an escalation, but a marked escalation in consumer loan impairment rates and also rising pressures on household cash flows. This doesn't bode well not only for the economy and the consumer, but also the retail sector of the JSE, I would imagine.
Quite right, Lindsay. So as you quite rightly pointed out, the impairments are currently growing at levels last seen in 2008, and if I can remind everybody that was just prior to the big crash that we had shortly after that. So we're in fairly difficult territory at this point in time. I think there's a combination of factors there that are weighing. Of course, we've seen the employment stats. The employment stats not looking particularly good. South Africa has been losing jobs. If one has a look at the manufacturing PMI and one looks at the employment subcomponent to that PMI, it's very clear that we've been shedding jobs, certainly in the manufacturing sector. And of course, we've got still the threats looming about potential job cuts in the mining industry. So all in all, employment not looking particularly good, regardless of the modest decline in the unemployment rate, which we see as statistical. And you couple that with an increase in price pressures, or price pressures that have remained slightly more buoyant than they were this time last year, and you've got a recipe for a much more difficult environment for the household. And let's bear in mind, this is before the Eskom tariff increases kick in, and before things like the e-tolls that may still come later this year. So all in all, it's looking like a trying time for households, trying time for consumers. And I think you're quite right to point out that this is probably going to impact both on impairments at a banking level and potentially at a consumer expenditure level for the retailers.
We had ABSA's numbers out last week, and having a look at them, their impairments weren't particularly good. There was something like 63 or 64% increase, or something like that. I don't know if that's the case with all the banks. We've had Nedbank coming up with the trading statement this morning, showing some good, healthy potential increases in headline earnings per share, something like 18 to 23%. I think they're estimating. But so these numbers are going to come through towards the third and fourth quarter, maybe. But the one that interests me is your analysis of credit card utilization, because people are using their credit cards because of all the factors that you've just spoken about. That's going to impact in the future when they have to pay these things back.
Exactly right. So depending on the prevailing environment, utilization of credit cards, for example, can reflect distressed use of credit. So we look at that and we pay attention to that very carefully, monitoring the use of that credit facility relative to the opening balances of those credit facilities. And when it reaches a level that is a little too high for comfort, we know that that's potentially problematic for the future, and something that we'll need to keep an eye on. Again, it goes back to the same point we made a little earlier with regards both to the impairments and the difficulties that may be experienced by the banks and the retailers later this year.
When you look at what happened this morning with the CPI, okay, some people are saying it's because of the reweighting and a new calculation of the consumer price index, but it came in at 5.4%, much better than expected. And when you see the sort of numbers that you're talking about now in your analysis of the consumer, it's got to be that the interest rates at best will stay flat in 2013, and even better, might even go down.
So, of course, there was a lot of speculation following that CPI number, and you're right, 5.4 was a little lower than the 5.7 anticipated. You do get some vagaries, and this one was a slightly more difficult month to predict by virtue of the fact that there were statistical changes that we needed to take into consideration, one of them being the change in the base. But having a look at the breakdown, we saw that it was in fact the food component that surprised to the downside. Now, the significance of that is that if one has a look at the trajectory that we're anticipating through the course of the next 6 to 9 months on food, in fact, the trajectory is still up. So we need to be careful about reading too much into this number, because by our readings and by the measures that we look at, which could govern price pressures at a food level going forward in the months ahead, the risks are still to the upside. And I think the Reserve Bank was quite right to mention that at the last MPC meeting. So we're not out of the woods yet. Inflation still a little concerning to us, and we think that there's a high probability that we break above that upper limit of the 6% mark, which is why I would caution against anticipating too much in the way of rate cuts, although one can't rule it out completely. At this point, the inflation environment makes it a little tricky for the Reserve Bank.
Very quickly, George, last 30 seconds. Are you fearful for the South African economy, given the fact we are a consumer-based, consumption-based economy rather, and given the figures you've had? I mean, do you think it sort of snowballs and this thing could get worse?
Well, I think there's a limit to how far it can deteriorate. Fortunately for consumers and those that are in debt, interest rates are still low, and that portion of the consumer credit index still reflects an unchanged environment. So not increased pressures coming through from the central bank and the regulatory type environment, but you are correct in the sense that consumption expenditure and that consumptive trend has been forming a fairly substantial proportion of the GDP contribution that we've seen in the past couple of years. And if that were to weaken, as we anticipate that it will, courtesy of what we see reflected in the consumer credit index, then I suspect that we'll probably have a more sluggish GDP performance through the course of 2013.